Good morning. It's now July the 8th, and this is another episode of Two Grey Beards. Hi, Andy. So, what do you think was relevant from last week? What did we learn, if anything?
Hey, Nick. Good morning. I think it was a pretty important week. In particular, the bond market action was consistent with what we've been saying for a while now, but we started to get the actual moves. NFP showed signs of what could easily be called stagflation, in that there was fewer jobs than expected created, but wages went up, and the impact on of that on total spending was greater than the lack of job creation. So it was warm, but the prior day, both the jobless claims and ADP were pretty hot, and so all rates went up.
Yeah. Now, we are definitely getting signs of distress from both the yield curve and from the bond market in general. We closed at the highest levels for 2023 at the long end. We are trying to make new highs at the short end. So definitely the market is beginning to take heed of the dot plots. We've now priced in the two hikes that we're going to get this year. I think the market is no longer arguing with that, and it's been arguing with that for a very long time, as we all know. And now the market is trying to decide, when will the Fed be in a position to ease? And it keeps on pushing out this easing, which had been baked into prices. We were expecting the Fed to start easing towards the end of this year, and now it's pushed back into Q1 of 2024, and it could easily even be pushed back into Q2 or Q3 of 2024. And therefore, the belly of the curve, the 2-year, the 3-year, the 5-year, are beginning to give up and go for high yields. And eventually, that is bound to be translated in the long end as well, because nobody likes paying negative carry forever. They need to see a reason to buy bonds at 4% if the negative carry is going to be 1.75% for a long period of time. And that just ain't happening. And therefore, this is constantly pushing up yields, and any rally we have in prices gets sold very quickly.
Right. Next week we are looking at two data points, the CPI and the PPI. And of course, also we have an auction week where threes, tens, and 30s are going to get auctioned,
Yeah.
as well as the tremendous amount of bills that are being issued for the TGA. Markets don't move in one direction forever. What do you think if the CPI comes out low, say 2.9 year over year, and core is, say, 10 basis points low at maybe in the fours? It probably rallies on that. There's some interesting, is it the bottom of this cycle's CPI?
Yeah, I think any rally in the bond market, any significant rally in the bond market, is going to get sold within a couple of days. There is a very good likelihood that these numbers in for June are going to be the low point of 2023, and we're actually going to get some higher numbers for core going forward, especially because these are out of technical reasons, because we are no longer getting the drops in energy prices that we were at the beginning of the year, and we are benchmarking against different levels. But it just looks to me like the likelihood of core inflation going back into the twos at any stage in 2023 or in 2024 has to be very low. Those odds are very low. And I think the Fed is probably going to have to increase the dots, if not for 2023, then certainly for 2024 and 2025.
Right, and we'll see that not in the July meeting, but in the September meeting if they change
Correct.
them. But for
Correct.
now, with the dots where they are, I agree with you. 2023 is probably pinned a bit to the
Yeah.
dots. Like, you'd need some really hot CPI, PPI numbers for the market to say, no, we haven't believed you for years, and now we're going to think you're going to hike even more. That's
Yeah. Now we've thought you were talking rubbish for a year, but now we're going to out hawk you. I think that that is unlikely. I think the short end is pinned. Certainly 2023 and Q1 2024 pretty much pinned, but the rest can move quite a bit because we're still
yeah,
discounting a lot of easing in 2024. And therefore, that can be taken out to show that basically real rates aren't going to drop below 2.5, 2.25, on top of 3. That gives us something in the fives. So it's not unlikely that the middle part of the curve and the long end can keep on going higher from here. I really wouldn't want to be an owner of bonds until we get, and I'm talking about 30-year bonds, until we get to at least 4.25%.
as it relates to our macro outlook, higher for longer remains the theme. And even if we get a slightly cool CPI, that could have all sorts of these things like we call base effects, and that's a sell bonds opportunity. And then we run into earnings season. We don't know. At some point, and I don't think it's yet, but at some point, earnings are going to begin to top out, and you'll get, if bonds do what we think, you'll get this combination of multiple and earnings compression. Multiples driven by the rise in rates and earnings driven by an economic slowing. The economic slowing, it's slowing, it's just not slowing that fast. So I'm a little suspect we're going to get a meaningful earnings compression. And frankly, earnings could be good as long as the Fed remains, as long as cuts remain priced in through 2024. We're not going to get the sort of rapid weakening of the economy that would hurt earnings. So it's interesting, but I agree that the play now in the short term is we have this inversion lifting up the long end, the front end's pinned. That could generate a new low in TLT. I'm thinking by the end of the month, FOMC time, we might have a 4.25 long bond and a TLT that's in low to mid 90s.
Mm-hmm.
And that should drag SPX, even with fairly decent earnings, to the 4,100, 4,200 level. What do you think about, should we do anything today, given that we think that those might be viable opportunities?
No, we have the opportunity to. Volatility is so low, even if we were to sell a 94, 95 strike in TLT or a 41, 4,200 strike in SPX, you get almost nothing for it and you lose a bit of optionality if the market very quickly gets there, because you'd have to cover the puts.
Yeah.
That I think it's probably much better to wait. We have so much cash available. It's probably better to wait, do nothing. And if the market gets there, those are our levels that we're already warning our subscribers about. 41, 4,200, SP 95, TLT are the levels that we think deploying cash makes sense.
Yeah, I agree. Okay, so it's going the way we expect, and we're well positioned for it. And, after next week's CPIs, we'll have a very good sense of what's going to happen in the July meeting. And then, my big view is that for bonds to really sell off, or for equities to really sell off, we're going to need a change in the supply dynamic of that's coming out of Treasury in terms of their issuance. More on that in future episodes, but on August 2nd, we'll have a big piece of news, and I just want to let you all know that's on our radar.
I agree. August 2nd is going to be very important. And from then on, things should be much clearer as to the path of issuance and therefore what rates, long rates, are likely to do in for the rest of the year. In which case, we will have much better target and much more precise targets for the equity market and what that's likely to do.
Yep. Okay, Nick. See you next
Thanks,
episode.
Andy. See you next week. As far as the positions are concerned, these are the approximate allocations that we have. Naturally, everything is in the broker statement. What I've done is I've removed the files because the Excel file itself was beginning to be so large, but every single statement can be downloaded at any time using these links. And I've also updated the June monthly statement, and the monthly performance, as you can see, is here. There are no orders for the 8th, as we've just said. We know what we want to do, and when the market reaches those levels, we will either send you an email or do an emergency video. But in any case, you will be thoroughly informed. Thank you very much indeed, and have a lovely summer.